You want it? We have it. The hottest mortgage and real estate strategy broadcast in the nation. A Smarter Way Home with your host, Danielle Boote and Victor Bals. 50 years combined experience, ranked in the top 1% in the nation for home loan originations 2020. Promise to expand your knowledge, utilizing creative mortgage financing and home buying strategies. Build a bridge for a better quality of life. Get your brain cells firing for a smarter way home. And good morning, everybody, and welcome to another episode of A Smarter Way Home. I am your host, Victor Bals, loan officer for over 20 years, and we like to discuss modern mortgage and home buying strategies for consumers and real estate professionals alike. It is a beautiful day here in Detroit in this mid-September, and I want to introduce my hostess with the mostest, Mrs. Danielle Boote.
Good morning, Victor. How are you?
I am very good today, and it is a beautiful Thursday morning here in Detroit, and
Yes.
I love it. And boy, the market's been kind of crazy out there. Interest rates are going up. They're saying they're at the highest they've been in several years. So,
yes, they are. It's
but
not fun.
Yeah, but it's a great opportunity. So what are we going to discuss today? Because with the higher rate environment, to me, it creates a lot of opportunities for well-qualified buyers, because I see a lot of people kind of, let's just say throwing in the towel. There's some uncertainty. They don't know where inflation's going. But for the well-qualified buyers who want a home, there is some great opportunities out there. But there are some things we should and shouldn't do. So what are we going to discuss today here, Danielle?
Absolutely. Well, one of the first things to discuss with the real estate market, and this is always a true statement, but real estate is seasonal, okay? Mm-hmm. Michigan has a certain season, and every other state has a certain season. In Michigan, our real estate typically starts ramping up in March, and then we go through the selling season, which is usually strong through maybe June. Mm-hmm. Then what we typically see is a dip in the middle of the summer. Why? Because everybody's on vacation. Yep. And then things will sometimes pick up again. Which we've seen this year. We saw. Yeah. So once the kids go back to school, then all of a sudden everybody settles back into their normal routine and starts
crickets.
Looking at it. Right. So usually about 2 weeks after the kids are back in school, then we start hearing the phone ring again and people getting back to let's looking at houses, or I want to sell my house. So there is a seasonality to it. And if you are not let's call it a lifelong student of the real estate market, you could easily look at that and go, oh, Like I've had conversations right now with clients that are trying to buy and maybe have a house to sell, and they're concerned because of the time of year. What if my house doesn't sell as fast? So in our market, we are seeing more listings, and we are seeing homes take a little bit longer to sell, which is not a bad thing if you are a buyer, because you're going to have more opportunities of homes to look at. Homes are still selling quickly, but it's a different pace than it was maybe 6 months ago.
Well, to add on to that too, with the higher interest rate environment, we are also experiencing some price drops a little bit out there. Mm-hmm. We're starting to see some good opportunities, and especially for those who do not have a house to sell.
Yes. This
creates opportunity.
Well, two things that I see in the market with any homes that are dropping price: condition. Buyers will pay top dollar still today for homes that are in excellent move-in ready condition. The other part of the equation so we are seeing in some cases homes still getting multiple offers. Maybe it's not 15 offers, but they could still have 5.
Yeah.
Okay. And they still could potentially go over asking price. There's also still a strategy with the listing agents where are they listing it on the high end of average or on the low end of average? If they list on the low end of average and that house is in nice shape, they're going to get multiple bids, and it's going to push the house price where it should be for the market. So it's not, is it really selling over asking, or did they list it on the low side? That is still occurring. Right. What's not going to work if you are a seller is overlisting your home. And if your home doesn't have up-to-date amenities, fresher paint, a newer roof, windows that are less than 50 years old. Those are the things that buyers are looking at, and they will discriminate on those things. And I think one of the other mistakes that I personally have seen realtors make is overlisting homes based on their zip code. In our area, for instance, Brighton has a different real estate market than Howell. It doesn't mean that Howell's not valuable, but you can't list a house at the same range of what you would see in sometimes other communities. And then again, the house is going to sit, and then that's not good for the seller either.
And that's a psychological thing, because if the listing agent listed a little bit over market, and sometimes the sellers actually drive that and say, my house is worth this, I don't want to sell it for less than this. If it is overpriced on what the market is willing to pay for, sometimes it stays on the market. It becomes stale, and the potential home buyers say, it's been on the market for a while, there must be something wrong with that home, when there could be absolutely nothing wrong. It's just a little bit overpriced.
It was overpriced. Exactly. So
as we get into talk about today's show, there's some great opportunities out there, and we want to reiterate to our buyers on some things not to do as we are walking into the home buying process. And prior to the show, we were discussing something, and I would think that was probably the number one thing not to do. So explain us on some of the things, Danielle, that you see customers doing when, and not knowingly, they just don't know how it's going to affect the mortgage process. But what is the number one thing not to do when buying a home, then, in your opinion?
Don't forget to pay your bills.
Yes.
And here, the topics that we're going to discuss right now, you may listen to this and say, well, that's crazy. Why would anybody would do that? And Vic and I can tell you that we hear these, somebody does this every week. So this list we're going to go off of, like one of our loan officers came to me yesterday with a problem on a file, literally had it clear to close, and the borrower forgot to pay a credit card bill. So we're clear to close. We had to do the last credit refresh, and we come up with a current late payment.
Oh my, a 30-day late.
Yeah.
And do you have to go ahead and get a rescore and repull credit?
No, in this case, they had to go back to underwriting. We had to rerun desktop underwriter, which guess what? It then referred the file. It went from approval to refer.
Oh, that means a no.
That means no. So now we have a clear to close loan that was scheduled to close.
We have a clear to close loan that's not clear to close.
Yeah. Now, luckily in this case, it's a refinance, so it's not stressing out the realtors. But this is somebody that our loan officer had been working with for a really long time. And you go, so please pay your bills. I had another borrower that was a past client of mine that had a great payment history and screwed up paying a Victoria's Secrets card. Something happened and the auto pay didn't trigger, or she didn't have auto pay set up because she never used the card, and it really dropped her credit score. So, do not forget to pay your bills. Have all the important things, even those store credit cards that you rarely use, set them up on auto pay with a minimum payment. So in case you forget something, or you go on vacation, or you had a medical emergency and we're at the hospital, for God's sakes, your bills are on auto pay and you will pay your bills on time.
Oh, absolutely. Well, now, and here's another one of our employees at our office had recently sold their home. Right. And she had bought a new home and was asking me if she should still make the mortgage payment on her other home because it's under contract. And I said, absolutely. And if it's on auto pay, stop the auto pay, but make that payment, because we don't know if they'll close. They may be close to closing, but something could happen to their file.
Right. I mean, in that situation, I would say you pay it on the first. And you know what? If you're in the middle of selling a home, and this goes if you're refinancing too, because I've seen a lot of people over the years screw up their credit because they stopped the auto pay on the mortgage. I would leave the auto pay on, and if you pay it, you pay it. And if it closes the day before they pull them, unless you have a confirmed closing date, do not cancel the auto pay.
Absolutely.
And
as we talk about things not to do, like you said, don't stop or continue to pay your bills.
Right.
And one of the other things not to do is, what you need to do is you need to check your email, because we send these tips to you during the process.
Yes.
continue to pay your bills, and you need to check your email because we're going to coach you every step of the way on there. So
and read the email.
Yeah.
Don't just look at the email.
Yeah.
There's important information. I mean,
Yeah.
and a lot of life things right now. Everybody gets their bills via email, right? You're not getting paper bills most of the time anymore. And people don't read the emails.
Yeah, because, in order to keep a transaction going timely and smoothly, we like to communicate via email or phone call, but please check your email. Prior to the show, we were talking about a situation you had on one of our loan officers doing a pre-approval for a client. And the thing not to do is don't retire
in the middle of selling and buying a house.
Yeah, explain that situation, Danielle. What happened there?
Well, we actually, there's a lot of people retiring right now from the workforce, and there's several angles that we have to consider. One of our loan officers had someone actually apply for a mortgage online. They put all of their current job information, including the income of what they were making when they were salary.
And they submitted pay stubs,
W-2s in the file. I mean, this is a seasoned couple buying a house. This should be slam dunk, no problem. They wanted to buy a new house before they sold the old house. Based on all the initial information, the borrower qualified without a problem.
Okay.
No questions asked.
To buy and then sell.
Correct. So they were going to qualify with two houses.
Okay.
They've completely failed to mention to the loan officer that they were in the process of retiring.
They or
the husband.
The husband.
I don't think the wife had any income already. I think she might have been already retired. So now the husband retires literally 2 weeks after submitting all this information.
And took a big, huge income hit.
Huge income hit. And here's the other problem with retirement. When you retire, it doesn't just literally go, oh, boom, tomorrow I get my Social Security check.
Or my pension check.
Correct. Setting up your pension and setting up your Social Security can take 3 to 6 months.
Okay.
Which means if we do not have proof that you are receiving that new income, we cannot use it to qualify for a mortgage. And the minute you resign from your job, this is whether you're retired or not, you resign from your job, we can no longer use the income. I don't care if you resigned 2 weeks prior to switching jobs or 30 days. If you resign and your employer tells us, oh, Mr. Jones is retiring on October 1st, we cannot use that income. So it's very important to disclose that information to your loan officer, to be upfront, and to really look at it from a budget standpoint, right? Now, you also shared a very interesting retirement story with me as well before the show.
Okay, well, actually, that's somewhat of a success story. But so I had clients come in last night. I've been working with them for a couple months, and they're about 3 years ago. They bought a home on the lake, and about 2 years ago, the husband decides to retire. Okay, and so he took an income hit, and they had a beautiful house on the lake, and it was kind of expensive. The wife didn't make extraordinary income, had a nice, decent job in that, but the bills started to add up. So the husband, because this couple, they keep their finances separate, okay? And so the husband was taking care of the bills, and he's seeing something happening, so he ended up utilizing his credit cards to pay everything, and he racked up his credit cards near about $70,000. And so when they went to sell the home and they did an application, she had a great 780 credit score, and his credit had crashed down to 630 because he has maximized all his credit, okay? And the wife didn't know about this until we brought him into the situation. And so the first time they came to my office, and I basically had a reality meeting. I said, look, your credit is this. And she says, well, my credit's 780, And I go, well, it doesn't matter. We're going to use
You're not going to qualify without your husband.
We need both of your income for one, but we're going to use the lowest middle score of both borrowers. And so they actually got in an argument in my office regarding, how did you use all the credit cards and all that? And I said, hey, man, I'm just a guy in the middle. I just report the news. I don't create this, And she was adamant that they were selling the lake house and they were going to downsize. And we got an accepted offer on a $364,000 purchase, okay? And this was listed at about $390, and in this environment, we're seeing these price drops. So anyway, they got an accepted offer. And she was adamant, they're netting about $307,000 from the sale of that home. And she says, I want to put all $307,000 down. I want a $60,000 mortgage. And I said, okay, that's fine. And I put in the numbers on the big screen and I said, look at there, that's the debt to income ratios. You won't qualify. She says, what do you mean I won't qualify? I'm putting $300,000 down on this house. I go, because of the $1,700 a month in credit card debt, the minimum payments, you don't qualify. And she was kind of irate about that. And so I said, let's restructure this a different way. Let's pay off all the credit cards. Let's free up $1,700 a month in cash outflow. Let's put 50% down on that home, that $360,000 home. Let's put 50% down. Let's pay off your credit cards, free up $1,700 a month in cash outflow, and let's keep $80,000 cash in an emergency account so you don't have to use the credit cards again. And she says, she started to warm up to that idea. And then she says, I want to put more down. I don't need $80,000. I only want $30,000. And I said, okay, that's fine and dandy, but you're buying a new home. Are you going to need any blinds for the home? Well, yeah, I might need that. Does it need any painting? Yeah, it needs this and all that. And I go, well, I tell you what, why don't you try it this way? Let's go ahead and put 50% down. Let's keep $80,000 into your emergency account and put it in an emergency account under your pillow, making 0% interest if we want to, right? And she says, okay. And I said, or you could put that with a financial planner. You could draw maybe 4 or 5% on that. And, and she started to open up to those ideas. And she says, no, I want to put another $30,000 or $50,000 down. And I said, okay, that $50,000 down, that's only going to drop your payment by about $304 a month. And I said, so if we put that with a financial planner at 5%, you're going to gain $260 a month, $250 a month just in interest, okay? And so she started to warm up to these numbers. And so they are going to move forward with the plan, and they're going to keep that $80,000. And I said, and right now you're in a high rate environment. Let's just use this mortgage as a Band-Aid until we put the stitches in, because now that we're paying off all your credit cards within 30 to 60 days, and I did the credit simulator for them, and I go, look, his credit score is going to go up over 700. So let's go on with 50% down, pay off all your credit card, live in this for 6 months. The rates will get better next spring. You'll have over 700 credit score. Let's refinance at that point. You've had 6 months of living in this new home. Everything is done. If you've still out of 80,000, still have 80,000, and you want to put something down,
you can then.
Now let's refinance. You bring money to the table, and now let's not go to a 30-year term. If you want to shorten the term, we can, which I actually advised against. I said still go at the 30-year term and add a couple $100 to the principal and pay this thing off in 17 years. So anyway, it was kind of a success story, and we're moving forward.
Well, that it's really important from from anybody's standpoint, whether you're retired, if you have a house to sell, okay? Right now, sellers have more equity in their homes than I have ever seen in my entire career. Young people that have been homeowners for 5 years are walking away with over $100,000. Somebody that's been in a home longer or put money down when they bought 4, 5, 10 years ago are walking away with $200,000-$300,000. So this is a unique opportunity to seize for anyone to really set yourself apart for planning for your financial future.
You know, this is funny because now I brought that up in this conversation as well, and I sat there as they're kind of complaining, and they're just in awe, and I said, boy, you guys got some nice problems to worry about. And they start laughing. They say, what the hell are you talking about? We got nice problems to worry about. I go, well, I can tell you what, inflation and appreciation has helped you. Imagine if you rented 3 years ago, okay, and then you retired and you racked up all those credit cards, you'd be in my office right now with $60,000, $70,000 in credit card debt. You should be thankful for appreciation and time.
Correct.
You're not paying off that credit card debt. Time is paying off that credit card debt because you bought that home, you let appreciation get there, and now that's wiping out $60,000, $70,000, $80,000 of your credit card debt and putting $80,000 in your pocket.
Right.
And then they started to realize, they go, yeah, I guess we kind of do have
It's
some
almost
nice
like
problems.
winning the lottery.
Yeah.
Right. And I know that real estate has risks, but anybody that's jumped into it or, in the last 10 or 15 years, honestly, has done extremely well and certainly better. You're correct. Better than people that are sitting renting for decades.
I used your analogy. I said, marry the home and date the loan. Marry that home, date that loan. Marry that home, date that loan.
Right.
Because you've often said, treat that house as a 401k.
Right.
And because in a 401k, at times you rebalance your portfolio and move assets around, that loan is going to be treated like a 401k because the loan I had to give them today, because of the credit, is not the sharpest knife in the drawer.
Right.
It is a Band-Aid till we put the stitches in. So what we are going to do is fix some stuff by paying down some debt, and then we are going to rebalance that mortgage, that 401k, to meet other objectives.
We have a few people refinancing right now. For a couple of reasons. I have somebody that just refinanced with a tremendous amount of equity in their home because they need to put an addition on, right? And we did pay off a lower rate mortgage, but they needed to pull out equity to be able to put an addition on. My client did think about selling and buying, and then he decided not to because he had property and said, look, I can put 1,000 square foot addition on this house. It will be worth it to invest this kind of money because he had property. So we did a cash out refinance knowing full well that, we'll refinance again in, 12 to 18 months or whenever we see the rates come down. And he didn't have concerns because he knew that he was taking this money and investing it in the property. Now, there are people that need to pay off debt, and there's a lot of different angles to consider regarding that.
Again, treating the home like a 401k. He's basically taking his home and taking out a 401k loan from his own equity to meet objectives, have that quality of life, and then we'll rebalance it as rates or the market changes.
So the pre-retirement thing is very, very important. If you are thinking about retiring, call a loan officer.
If you're thinking,
call a realtor and say, I'm thinking of doing this. What is my house worth today? Then call a loan officer and say, hey, this is what my strategy is. Here's what my time frames are. There are, for instance, the big three in Detroit are giving buyouts again. We have younger people, right, under 60 that have put 30 plus years in at one of the automakers that are now taking buyouts, that if you would have asked them 6 months or a year ago, they would have not been in that position. So there are a lot of people out there, I think, over the next 12 months that we're going to continue to see as the big manufacturers, basically they're downsizing.
Absolutely.
So if you're in that position, it's worth discussing, if you decide to make some kind of a move so that you understand what your options are and what they may not be.
So the change, retire. These are life-changing events, right?
Yep.
When you're changing a job, that's a life-changing event. You need to update your loan officer. And also, so if you're thinking of retiring, let your loan officer know. If you're thinking of changing jobs, that could have a negative impact.
Yeah.
If you're thinking of going from full-time to part-time, that could be a deal killer, or going from a W-2 employee and say, I'm going to start my own business.
Yeah.
We've seen that happen.
Yes.
Oh, and I've had it where people have actually quit their jobs once we get clear to close, and say, I'm going to quit my job, right? Come to know that we do a verification of employment just a couple days before that closing. And if they say you quit, that deal is dead.
Yep.
Dead. One of the other things is do not do here is buy or lease automobiles during the transaction. Talk about that a little bit, Danielle.
Oh, that happens. So obviously, if you're leasing, you're going to...
My lease is up in 2 months.
And, we've seen that, or people just go out and buy a car. Now, if you have... Sometimes it's fine that if you're... For instance, if you have a lease and you're getting a new lease and the payment's about the same, that probably is not going to impact your application. It will impact the paperwork we need from you because paying off a loan or a lease, and getting a new one does not instantly hit your credit report. So we're going to need to manually update it, which means you're going to have to give us proof that you turned in a vehicle or sold it, and you're going to have to give us proof of the new payment.
Because we got to count that payment
But there
against you.
are a lot of clients that we'll give pre-approvals to, and they don't call us, and they're like, hey, I just got a new car payment. It's $750 a month. I had to do it. Well, that could impact your ability to qualify.
Yeah, or I co-signed for my son. I
Yes.
co-signed for somebody on a new car. Remember, people, you co-sign for anybody, we are counting that debt against you for qualifying purposes.
Unless you can prove that the person you co-signed for made the payments out of their own account for 12 months.
Yeah, so don't just go co-sign tomorrow or during
Correct.
the mortgage transaction.
And
else.
that could be for co-signing for anything.
Mm-hmm.
If you co-signed on a piece of property, if you co-sign on a mortgage, you co-sign on a student loan, all of that counts, and we are going to count that against you.
Don't even consider it co-signing. Consider it signing.
Yes,
You just got a new debt.
took on that debt.
Oh, here's another one. Don't go buy furniture because you got a new house coming.
Oh, yeah.
Because they had a sale. Trust me, they're going to have a sale next Saturday too.
Yeah.
You know,
Yeah.
I had a client, they were buying a house from a neighbor, right? And 2 weeks before closing, they went to the furniture store and racked up $15,000 of furniture, okay? And they had it delivered to the house because they knew the neighbor and all this. This is prior to closing. So right near closing, we do our credit inquiry and come to find out that this person had racked up $15,000 in furniture debt. And now the payment against them, we couldn't qualify them with that payment.
Oh, my gosh.
So one, that person had to organize to have the furniture store come back, pick up all the furniture, take it back, and cancel the account. And in order for us to close it. So don't go
gosh.
buying furniture. I had another client where the mom co-signed for a son because he had a business and he needed a truck for the business. And this truck was a $900 payment, $60,000 truck for his business. And she went out and co-signed for him on this $900 payment. So the lady would not qualify. And so the only way she could buy this condo, she had already sold her current home. She had to buy this condo. The only way we could get her to qualify is she had to pull out $60,000 from her 401k, pay the 10% penalty, and then have to pay income tax on that to pay off that car completely to qualify to get into that condo. Just because they didn't call and update us on what's going on.
Well, I think a lot of people think that co-signing is not really a liability, but unfortunately it is, and we're going to look at it that way.
It is a horrible liability. Mm-hmm. You know what? One of the things we want customers to do is, don't wait to submit required documentation.
Yeah.
One of the things, remember, people, it's not us against you, against the underwriters. It's us as a team working towards a smooth transaction. And in order to be timely, we need you to check your email because our loan processors and our staff and ourselves are going to ask you for specific documentation from what we know and or what the underwriter will require. So please be very timely because that can really hold up a transaction. And also when we ask, for example, for a bank statement, we want all pages, right? Not just the front page. We're not looking for bank activity. We're looking for actual statements. And how many times do we not get complete statements?
Every day.
Every day.
Every day. So most people nowadays do online banking. And they'll screenshot us a picture of the app. So the screenshot of your app on your phone is not a bank statement.
Well, and also it doesn't show your name and or an account number.
Or the bank information. Yeah. So we actually have a really cool system called Account Check. Mm-hmm. Does not work with all banks yet, but it works with major banks where we can send to our clients a secure link. Okay, Account Check is a third-party company that interfaces with our computer software, and if they give us temporary permission, we can actually digitally pull the documentation that we need.
And actually on our digital application or online application, if they enter their banking information, with all the account numbers. That makes it very easy for us to pull that bank data if it's available.
Right. But everyone gets a real old-fashioned bank statement. It is somewhere in your online banking system, and that's what we need. So if the document says 1 of 4 pages, and that 4th page is that balancing sheet on the back page.
Left blank intentionally.
Yeah, we still need that left blank intentionally page because it's numbered, and it is an official part of the document.
And one of the reasons why the underwriter may ask for that left blank intentionally page so they can see the number, because it could have some loans out there that maybe you're on the hook for, and they want to make sure, because their job is to make sure that everything is clean and tidied up. All the T's are crossed and I's are dotted there.
So we can move loans very quickly through the system if we have complete cooperation. And this goes back to, checking emails, checking your text. We'll ask questions up front. And I encourage this of everybody on our team to say, look, ask your client how they want to be communicated with. Do they check email or not? Yep. Do they prefer text or not? Do they even have voicemail or not? So let's find out our clients' preferred communication. So we are trying to communicate with them in the most effective manner, but we need everybody to reply quickly.
Absolutely. And here's one of the things that I want to tell people, because a lot of people think, I'm going to buy a home. I've got some credit cards. I'm going to pay them off. I'm going to close those credit lines.
Oh, yeah, that's a nightmare.
That's a nightmare. What's your advice on closing any credit lines?
Do not close any credit lines during the mortgage process.
Even don't pay anything down until you talk to a loan officer.
Yeah. Yeah, because sometimes paying something down could make the credit drop before it goes back up.
Yes.
What I'll tell people is, look, if you really don't want to use that credit card ever again, okay, you can cut it up. You can shred it, throw it away, but don't close it immediately. The credit bureaus do not read the difference between a creditor closing the account or the consumer closing the account. So let's say somebody thinks they're cleaning up their credit and they're going to close 3 or 4 accounts all at the same time. Closing that many accounts in a short period of time is way too much negative activity, even if that account was always paid on time. And that is going to cause a negative effect on the credit scores. Now, if you really say, I moved out of that state, I'm never going to that store again, that's fine. If you're in the middle of buying a house or anything big, including a car, don't make any major moves until you get through the big transaction. And then if you want to say, okay, I'm going to close that store card from when I was in Philadelphia or something, then you can go and close one and then let it sit. And then if there's something else you want to do, give it a couple months and close that out, but be very strategic. Like I had a customer a couple years ago, young man looking for a lake house for over a year. He had excellent credit. He was in the 740 range. So when he came back to me to update his pre-approval, I was like, yep, here's an updated pre-approval. Send me your fresh pay stubs. He didn't tell me that he had paid off and closed all of his debt.
Thinking he's doing the right thing to be the perfect consumer.
Yeah. His credit score dropped over 100 points. And honestly, because he was a younger man, he was in his mid to late 20s, he was established, but he didn't have like 20 trade lines. He had 4 or 5. He had a student loan, a car loan, and a couple credit cards. Perfect. Paid off the student loan, done. Paid off the car loan, done. Paid off and closed the credit card, said I'm never going to use them again, done. He literally cut all of his history.
Yeah, so we have no history to say that you pay your bills on time.
Right,
so now the creditors or the credit bureaus look at that and say, we have no way of knowing what you do, your pattern. So our opinion of you is less, which drops your credit.
And even after he did get his house, but it cost him more money in the interest rate. Even after he went through all of that, I mean, a year later, his credit score still had not gotten back up over 700, which was crazy. I mean, I'm not saying I agree with that, but it's the way the bureaus work and the way the credit scoring model works.
So you have to treat a life-changing event, changing a job, quitting a job, moving money around, applying for credit. When it comes to mortgages, people, all of those are life-changing events.
Right.
It could change everything.
So here's the other big thing is what not to do during the process is do not deposit cash into your account.
The cardinal sin.
Yeah. We cannot use undocumented cash.
Well, I run the soccer team and I got all this cash from all the parents for the banquet.
Yeah, we can't use that. And even for instance, like Venmo or any of those apps, Zelle, that's all considered cash. We cannot use that.
And why can't you use my cash? I deposited $300 from the soccer team.
Well, according to mortgage guidelines, all assets have to be sourced and seasoned for at least 60 days. Now, there have been some changes to guidelines on deposits. For instance, if we can document you're married, you just got married, and we can see deposits that were around
from
that
the gifts,
time,
from the wedding,
from the gifts, that could potentially be used. But if you just show up and put $5,000 in your account and say, well, I had cash at home, no, we cannot use that at all because it's not sourced and seasoned. What the mortgage world is, and the underwriters are concerned about, is we're concerned that somebody borrowed that money somewhere and is going to have to pay it back.
Yeah, or the underwriters are actually looking at, okay, you had a $5,000 deposit. They're also looking, I wonder if this person potentially has another business out there that they're receiving this cash and they're not paying taxes on it. It's not being reported.
Could be.
On their tax returns.
Could be. Or there are also some loan programs, including rural development in MSHDA, that have income limit requirements on them.
So if that money is income, you may not be eligible.
Right,
yeah,
right.
Okay.
If you have a side hustle that you're not telling us about, that could be counted against you for certain loan programs. So cash is not acceptable, and we have to be very careful with that. So if a borrower tells us that they have $10,000 or $50,000 available, we need to see it on paper. Yep. Where is that money? Where is it coming from? Now, there are some situations where like a gift is acceptable, but we need to know who is giving you the gift and how are we going to document it properly.
And there's a gift letter that needs to be filled out.
Yep, before all of that happens.
So all these things to do, because people I don't think they just wake up today and say, I'm going to go buy a house.
No.
Generally, it's a couple month decision.
Sometimes they wake up and say, let's go buy this house.
Yeah, sometimes they do. But in most cases, people, if you're thinking about buying a house, this is on the radar, we needed to get with the lender. Sit down and talk about all the life-changing events or your goals, your objectives, because we can surely make it a less stressful process.
Absolutely. And one other thing that kind of piggybacks with the cash is the Earnest money deposit check.
Okay.
So when you are buying a house, you are going to have to write, in our market, we call it an Earnest money deposit, to the real estate company to say, this is my good faith deposit. Let me apply for my mortgage so I can buy this house from the seller. When buyers are not prepared for that and do not have the liquid assets in a bank account, then we have a problem, right? It could be $1,000, it could be $5,000, it could be more if it's a higher priced home, but we need to document that paper trail. It cannot come from a credit card. It should not be even written by someone else. And how many people don't have checkbooks today?
Many.
Yes. So if you don't have you have a checking account, but you don't have printed checks, then you need to make arrangements. It would be acceptable, as an example, to go to your bank, get a cashier's check from your checking account
or a money order
and write it, to the real estate company. Now, money orders are kind of goofy. Okay. Banks, I think, will still do money orders, but a lot of times party stores will. Okay. And here's the problem with that. I don't like money orders because somebody could walk into the party store with cash, buy the money order, and think it's going to be good. And if it's not coming out of your checking or savings account, we cannot document it. So someone really should not be writing that deposit on your behalf. So I've had young people or first-time homebuyers say, well, I don't have a checkbook, so I gave my money to my mom and she wrote the check. No, that is not going to be a good thing unless it's truly a gift, and then we got to go through all this other paperwork. Yep. So, think about it. And this we've tried to school the realtors on.
Right.
We've had people go, well, I got cash for my deposit. Nope.
It ain't gonna fly.
It ain't going to fly. So, you need to think about that. You need to be prepared. And when you're getting your pre-approval, talk to your realtor and talk to your loan officer about what kind of cash am I going to need so that you can start moving money earlier in the process and not be caught with, I don't own a checkbook and I don't have my money yet. It's,
That's why it's so important to get schooled a little bit early.
Yeah.
Come in and meet, and let's set expectations here.
Yes.
But we're going to go ahead and wrap up the show. And, and we always want to advise people, also use a professional real estate agent when you're out there buying a home. Mm-hmm. These people really earn their money. They're their weight in gold. And they can help you navigate and negotiate, and they know great lenders to work with there. Any closing words, Danielle?
Nope, I think we covered a lot of great topics today.
Yeah, that actually went a little bit over. So we're going to let you go, people, and if you got any questions, give us a call. You know where to get a hold of us, and we'll see you next time here on A Smarter Way Home.